This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of March 2026, and one topic that my colleagues at the Business Times have been reporting on recently is the Value Unlock program that the Monetary Authority of Singapore and the Singapore Exchange have launched to help companies strengthen investor engagement and sharpen their focus on shareholder value creation. This is one of the initiatives that came about from the work of the Equities Market Review Group, which was tasked with coming up with recommendations to revitalize the Singapore market. Now, I've talked quite a lot about some of the review group's initiatives in this podcast series already. In fact, in episode 63 in January, I talked about the dual listing bridge, which will allow companies with market caps of $2 billion or more to simultaneously list on SGX and NASDAQ with a single prospectus. And last year, I talked a number of times about the Equity Market Development Program, or EQDP, which will see $5 billion farmed out to fund managers with a strong focus on Singapore stocks and the significant impact that's been having on the local market. In my view, the Value Unlock program is going to be just as significant as these two headline initiatives, but it's rather more complicated. So to help me unpack everything, I have with me in the BT Podcast studio a man who is deeply involved with the Value Unlock program. His name is Chan Kum Kong, and he is the head of capital market development at SGX. Kong, it's great to have you here.
Thanks, Ben. Thanks for having me here.
I was rather surprised with the comprehensiveness of the Value Unlock program. It's really quite structured and detailed. But let me first ask you to take a step back and explain where this particular program fits into the overall scheme of things. Why is it a necessary element of the broader effort to revitalize the market?
Okay, Ben, to the point about unpacking the Value Unlock program and how it fits into the overall scheme of things, firstly, I want to outline what is Value Unlock. It could mean different things to different people. And how we see this is a Singapore stock market movement to heighten the shareholder value focus or value creation instincts at the boardroom. Now, while these measures has only started this year, work has been ongoing for some time in line with the EMRG initiatives led by Minister Chieh. And we've been engaging various market participants on how listed companies could play an important role as we seek to reinvigorate our stock market. So IPOs often capture headlines and attention, but the largest opportunity set is actually the pool of existing companies on the stock market that is already listed here. And so it is natural to focus on these companies as we seek a long-lasting impact. Now, to give you an example, we have recently launched the Next 50 Index. If all the companies that are trading below 1 times price to book, if they re-rate to 1 time price to book, there are about 23 companies in this range. The estimated market cap uplift is roughly about 23 billion, and that's a meaningful number. That's just an example to see, how much of an uplift we can get out of it. Now, the other part is we want to look at the experience of Japan and Korea. They had similar schemes. And from the point where they announced the schemes, their indices and topics and KOSPI has gone up by roughly 40%. So the important thing is then to look at, is that sustainable? And through the examples in Japan, we've seen that being sustained, that sort of improve in performance, because during the period of time, there were also tariffs, FX issues. But when the market rebounded, it was at the higher level. So that's the sort of resilience on a sustainable basis that we've seen from these markets. Now, if we take a step back and we look at the review group measures, it has been targeting demand, supply, and regulations. There are various measures that were targeted on uplifting different parts of the ecosystem, including the fund managers. There were also the research houses under the GEMS research grant that have benefited from the measures as well. So to complete the equation and create a virtuous cycle, it is equally important for the companies to step up under the Value Unlock program. Now, we know that if the companies put their minds to it, they can unlock value. We have seen these examples from Temasek portfolio companies Singtel and Keppel. With long-term plans on capital efficiency, they have articulated their strategies well and keep shareholders appraised of the longer-term goals. Naturally, these companies are outperformed in the past few years as their own initiatives unfold. Now, the goal is to replicate such initiatives at scale for the overall stock market. We have to get the board's buy-in, management buy-in to embark on their own value unlock journey. Now, a lot of these factors are already in place for the company, so this is a very opportune time. With more buy-side and sell-side attention on the stock market, we hope that the program will incentivize more market participants to adopt a growth and shareholder-focused mindset. So there are green shoots over here. In the second half of 2025, there were over 20 rounds of fundraising by mid-small cap companies. Some of them have seen their valuation improve by 30, some even have doubled up their valuations for the smaller ones, and they have taken the opportunity to do a fundraising to help them fund their growth or pay down their debt.
Okay, let's get into the program itself. When people talk about the Value Unlock program, they tend to immediately focus on the $30 million that MAS is putting towards two grant schemes, namely the Equip Grant and the Elevate Grant. As I understand it, the Equip Grant is to help companies fund the training of their employees in investor relations and public relations, corporate strategy, and financial management. Specifically, the grant will fund 50% of course fees in these fields, up to a maximum of $15,000 per company. On the other hand, the Elevate Grant is to help companies pay for the services of professional consultants in investor relations, media training, corporate strategy, and financial management. Again, the grant will fund 50% of the fees, up to a maximum of $200,000 per company. Now, there are some requirements for companies seeking these grants. In the case of the Elevate Grant, main board companies must have market caps of at least $100 million, while catalyst companies must be at least $80 million in size. More interestingly, and this was a bit of a surprise to me, according to information SGX has put out, the companies must demonstrate growth potential and a willingness to invest to get to the next level. And they must have a compelling equity story. Now, I'm curious about how it's all going to work. It seems to suggest that companies need to already have an idea of how they plan to grow before they apply for the grants in order to engage consultants. But even if they do, how would a company demonstrate its growth potential to SGX? How would you determine what is a compelling equity story?
There's quite a number of questions there, but I want to reiterate that board and management buy-in is crucial. Now, we want to work with companies that recognize the need to grow and to deliver shareholder value. And finally, how to communicate this well to the market. Growth is a necessary ingredient, but alone, it is not sufficient. Now, if growth is then followed by having a shareholder value creation focus, that's where magic can happen. I'm going to take the extreme example. If a company do not see a need to grow, then they don't see a need to do fundraising, and management may not see the need to be shareholder friendly or focused, right? Because if we have enough of these companies that are young, hungry, growing, they know that this is a long game. There will be multiple rounds of fundraising that they will have to engage. With that in mind, they will now realize the need to make sure that investors funding their growth are well looked after. With the growth coming in, the company should then be shareholder value focused, how to reward these investors that have been funding them. So that's an important linkage there that we need to put out. It is important for management to demonstrate this desire to grow, to engage, and to work towards a uplifting of value for the company. It may be a second generation owners looking to rejuvenate the business, or companies looking to venture offshore for the first time, where they will need hand-holding. They have a baseline narrative of the growth plan. In terms of determining what is a compelling story with that baseline, we will have consultation with market participants from both the buy side and sell side. Now, these are fund managers and brokers that are very familiar and they are close market watchers. With that consultation, the process is independent, balanced, and informed to make sure that there is a base narrative of growth to begin with, and then we will help them in terms of the grants to come in to see how to convert that through a communication process or through a corporate strategy review process. Now, I want to come to your point about the status of the application and how our experience has been with some of the companies out there. Since the launch of the grant in mid-January, we have very strong responses from the companies. We currently have engaged close to 120 of them, spread evenly across the large, mid-cap, and small-cap issuers. more than 60% of these companies have reached out to us proactively. So that's a sign that the program actually resonates with them. About 30 companies have signed up for Equip currently. That's a pretty good sign up from our perspective. On the Elevate front, we're taking a targeted approach. Beyond working with the buy-side, sell-side recommendations, we're looking out for companies with low ROE, which could be in need of a strategic review, and companies with high ROE but low PB, which means they're underpriced for the level of ROEs that they are achieving. They could be needing of professional expertise in articulating their equity stories. For companies embarking on Elevate, the engagement with service providers typically spans anything from 3 months to a year. And these engagements will blend diagnostics, advisory, strategic planning, and implementation support. But there are practical considerations. Companies with financial ending in December will be busy with their reporting. And beyond that, they have their own procurement process for selecting consultants. And then completing the review could take another 6 to 9 months. So it is a long game for the Elevate grant. And it is important to note that the Elevate program is designed to kickstart change. Ultimately, companies will need to execute, embed discipline and perseverance for the transformation of their business.
Have any of the grants already been issued to the companies?
Currently, we have not disbursed any of the grant because the companies will have to complete the program, be it Equip or Elevate, and there are certain outcomes in terms of number of engagements with investors. Basically, is to see them go through the training or the strategic review, apply what they have learned by actually engaging, going to sessions with, meeting up with investors, institutional or retail, or going on a roadshow. Some of this sort of KPIs, if you will, they have to complete that before we disburse the grant.
So they have to begin engaging the market first before getting the money to engage consultants and so on.
Not so much of that. The process is this. The companies will inform us that they are interested in either the Equip or the Elevate grant. They will select the service providers they want to engage. They will undergo that training or review, and they will pay upfront to the service providers first.
Okay, so the subsidy comes later.
The subsidy comes from a reimbursement format. But between completing the courses, they will have to demonstrate that they have put in practice what they've learned or trained. And then the disbursements comes in.
So they actually have to deliver results before they get the subsidy.
Yes, demonstrate that they have achieved those KPIs as well.
Kong, I would have thought that at that point, if they succeeded and the market reacts positively to what they've done, they wouldn't really be interested in having the subsidy at that point.
Now, at that point in time, they may think that it's not necessary, but I think at this point, at this juncture in the market,
they need some motivation.
They will need the motivation, exactly, the incentives to cross the line and get into that mode. We want to engage these companies, help them, nudge them across the line. And we want this to be a way of thinking and doing things in the stock market to create that mindset on an ongoing basis.
You're hoping that when a few of them succeed, it's going to inspire others to follow their example.
Absolutely.
Okay. We'll be right back after this.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Market, a podcast of BT correspondents.
I'm benpaul speaking with Chan Kum Kong, Head of Capital Market Development at SGX, about the Value Unlock program. Kong, while the Value Unlock program is only just getting started, the Singapore market has already re-rated significantly over the past year. Last year, the STI chalked up a return of 28.8%, with only a single constituent in negative territory. This was at least partly attributable to value unlocking initiatives by some of the big caps. You mentioned Keppel and Singtel earlier. Keppel has gone through a multi-year restructuring of its business profile. Singtel has also been monetizing its legacy assets and recycling its capital into new opportunities. But it's not just the Temasek companies that have been doing this. Some of the other family-owned businesses are also making big strides. Hong Kong Land, for example, has been changing its business profile and buying back its shares. So the large cap companies seem to be doing the right things, and the market is clearly responding to those moves. But a re-rating is also unfolding, as you pointed out earlier, among mid-sized companies, where there seem to be fewer headline-grabbing, value-unlocking moves. In fact, the iEdge Singapore Next 50 Index achieved a total return of 26.7% last year, with only 6 of its constituents at the end of the year in the red. What do you make of this optimism in the market? Do you think it's going to encourage more companies to explore the Value Unlock program because of the potential upside to their market value? Or could it backfire and result in companies feeling they don't really need to do anything since the market value of their shares is recovering anyway?
Well, companies today have good reason to believe that the renewed momentum in Singapore's equity market is not just a temporary upswing. Last year, not only did the daily trading volume reach its highest level since 2010, the STI index is at an all-time high, sitting at 5,000 levels. I think a broad base of nearly 100 Singapore-listed companies have recorded at least $1 million in average daily trading turnover. So there's definitely more buy-side interest in the market with the EQDP program, which itself has been upsized from 5 to 6.5 billion. And at the same time, there's been enhancements to the GEMS program. And that also means that the company will likely be able to garner more research coverage from the analysts. Now, various other measures such as fund managers' tax incentives, the push for better forward guidance, board lot size changes, and market-making incentives have also stimulated trading activity. These are the structural changes in the market, and we know that markets can be cyclical in nature, but for companies that are looking to tap on this bullish momentum, there's never been a better moment for companies to look inward, reassess their strategies, and uncover hidden potential to unlock. We think that the market will be able to appreciate that companies are doing more to drive their growth and uplift their value over time, as opposed to companies that are simply static. If we were to perform a simple desktop analysis of all the companies in the market based on ROE and PB ratio, we put them on a chart. The x-axis is the PB ratio and the ROE is on a y-axis. We can see broad improvements in the market. We take the category of companies with ROE above 8% and a PB ratio of above 1. The number of such companies has grown from the end of 2024 to 2025 from around 80 to 117. Now, for companies to be able to sustain good valuation and investor interest, it has to go beyond riding on the momentum to drive their own structural changes, to achieve growth and ensure that this is well communicated to their investors. Company will need to foster a long-term relationship with the shareholders and should not see an IPO as a one-off event, but the start of a long-term relationship that will help as they grow and raise funds in future.
Kong, you alluded to Japan and Korea earlier on. Japan and Korea had launched their own initiatives to improve stock valuations, so naturally comparisons are being made here in Singapore. There is a view that Singapore's program is a carrot and stick approach, whereas the Japanese and Korean programs are really more stick than carrot. Presumably, you've looked at what they've done and seen the reaction from their companies. Why did Singapore not follow their approach? Why was it appropriate to take a grant-based approach and leave it up to the companies to decide whether they want to join or not?
Well, value unlocking is not a straightforward, linear journey for markets or companies. And we will need the various stakeholders to weigh in to help contribute to the program's success. If we look at Japan and Korea, their initiatives have been multi-year in nature. We are just at the starting line. What we have introduced so far is in a form of carrot for companies to take a carrot approach, and this is an intentional approach. We know that companies are new to this journey, and it is helpful for them to see SGX MAS as a partner rather than a disciplinarian, bringing out the stick at the early start of the journey. And companies that are more enlightened or ready to start undertaking value unlock initiatives will create a positive example for the others to follow. So we want this to become mainstream as a movement.
Do you foresee any refinements to the program as we go along? Is it possible that if companies continue trading at low valuations, that you might take more of a stick approach?
Before I come to that, we also recognize the stick from regulators can be useful from time to time. I think we have not reached the stage where we've come to a conclusion, but nevertheless, we can calibrate and retune the program as we proceed and see what would be required. Now, at the same time, investors, the media can also put pressure on companies to do right and to do better in terms of shareholder value unlocking. Because as more active market participation gets underway, we see room for our ecosystem partners to play a role in shaping best practices. There should be active dialogue between companies and investors as well as the media. There will be uncomfortable conversations along the way. That's part and parcel of this process in terms of value unlock. Because we will need such nudges from time to time. Partners are telling us, giving us very good feedback, nudging us.
What is some of that feedback?
In terms of the disclosure, they have come forth with suggestions on the forward-looking statements and etc. So this is not unilateral from our perspective, but we have engaged the market and they've given us that in a space of mid-small cap companies, that's where they need the biggest push to have these statements. A big part of this is also working with the ecosystem partners, the buy-side folks, the legal professionals, the compliance folks, to understand where this is going. These are the stakeholders that needs to get comfortable with. As long as there's a good basis for the forward-looking statements, companies need not be afraid to put forth. Because a lot of the current situation that we hear, internally they may have hurdles, hoops to jump. Management have then become more hesitant.
So they're looking for clarity on what they can do and in fact what everyone ought to be doing.
Yes, exactly. Regulators have a column to talk about forward guidance on this area to help provide clarity to the market.
Okay, so you're saying you're looking for there to be more conversations between companies and investors and with the media. But how many companies are you ultimately aiming for? I mean, when will SGX and MAS know that they've succeeded with this program?
Value unlock is a long game where the actions taken today may take time to see fruition. But we do look at the success of the Value Unlock program through various lenses, and grant participation is one of them. What we want to see is more companies adopt a growth mindset with targets and goals centered around value creation. In terms of the metrics of success, there are two stages of it. At the initial stage, we do see activity-based, output-based sort of engagements, number of trainings that companies have gone through as important interim metrics to monitor, whether it's on track. The second phase would be outcome metrics that could be ROE, price to book valuation, compared to the weighted average cost of capital, how these accrue to shareholder value. Ultimately, it is about the success of the movement and the mindset shift that companies would see growth and shareholder value unlocked as an integral part of the business.
The evaluation of that second stage of the process sounds like a very long-term thing. Improvements in ROE and so on would probably not happen over a period of 6 months. It'll probably take a couple of years before you see results. Would that be a fair characterization of it?
Yes, it is a long-term process, and we want investors to recognize that aside from companies themselves. The experience of Singtel and Keppel is a very good one. iFast is another one, where they have shown consistent growth year on year. In the case of both Keppel and Singtel, they embark on that process. They have sold some of the assets round about 2022, and that continues. They made announcements in terms of their Vision 2030 for Keppel. And Singtel, more recently, I think in 2024, they announced their program over the next 4 years and look at the performance of the share price in 2025. That's where we see a significant uplift. So that journey is a multi-year journey that actually started in 2022.
Yes.
In the instance of iFast, they have been quite relentless and the level of perseverance that they've shown every year. They've bought bank licenses in Europe to expand the business, and they've continued to grow. And that, again, is a multi-year process for them. So we would like the ecosystem partners to appreciate that this will take time.
Kong, when one of my colleagues spoke to you a few weeks ago, she asked you which sectors are most likely to benefit from the Value Unlock program. Much to my surprise, you gave us a pretty direct answer. You specifically mentioned the construction companies. Can you tell us why and what other companies you think should take a look at Singapore's Value Unlock program?
Yeah, the construction sector is one that is currently experiencing structural tailwinds. Given the strong estimates from BCA for the built environment sector, including, your T5, MBS, HDB project, train lines, this is just one of the examples where the line of sight of such contracts is quite clear.
So there's a tailwind behind them.
Exactly. Rather than picking winners in the specific sectors, we want to facilitate and enable companies across different sectors to leverage on the current market momentum and resources available to drive their own value unlocking journey. The stock market flywheel has turned. We have a window to work with the stock market ecosystem stakeholders to sustain the momentum and build a stronger stock market for Singapore.
Kong, thanks very much for being here today to educate us about the Value Unlock program.
Fantastic. Thank you.
That's it for this edition of Mark to Market. BT Correspondents will be back next week with Wealth Editor Genevieve Hua, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcast@sph.com.sg. I'm benpaul. As always, thank you for listening, and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.